Hi, I'm Matt Rosenberg at RoseCap Financial, and markets are back up now. So I'm learning that a lot of my clients are contrarian, and that's because the question I'm getting asked the most often is now the time to sell. And I think people are saying that because we're coming back close to the all-time highs, even though we're still in the middle of this pandemic, and they're thinking, okay, there's flu season coming and things could get worse again, which I agree. And then we also have an upcoming presidential election in November where we could potentially see a new administration, which could lead to higher taxes, maybe some economic slowdown, and so on. So these are some big risk factors that are on the horizon, and I agree those are there. The question is, should we get more conservative? But the thing is, to arrive at a market price, you need to have a buyer and a seller. So even though prices are high right now, there's still people out there saying, I want to buy at this price. And in this video, I want to take just a few minutes to explain why I think there's another side to this story. So let's start by looking very simply at the P to E ratio of the market. And P to E ratio right now of the S&P 500 is 22 times earnings. The long-term average of the S&P 500 is 15. So if I'm paying 22 times the one-year earnings of the S&P 500, and it's normally 15, that would imply that the market is overvalued right now or very expensive. But what I want to look at is actually the inverse of the P to E ratio, which is the earnings yield. And the current earnings yield is 4.55%. So why is that significant? Well, I can essentially think of the earnings yield as the percentage of a price of a stock that I'm willing to allocate to the next year of earnings. So the thing about stocks, though, is you're not just buying the next year of earnings. You're actually going to buy the earnings and the profits forever for that company. So if I have a 4.5% earnings yield dedicated to next year's profits, then that means I also have a 95% of the purchase price of the stock is dedicated to years from 2 years going on. And so why that's significant is because things like the coronavirus and the election, even if they last for years, are going to be a relatively transient impact on the profits of a company. But one thing that is going to last a lot longer is the stimulus that's being put into place right now to get around the coronavirus. And our government could essentially put up to $3 trillion of stimulus in place to help with this, and that's not going to go anywhere. Here's another way to look at that. When the government creates a stimulus package, they're essentially injecting cash into the financial system to try to stimulate or sustain economic growth. And this chart does a good job of showing how our M1 money supply has increased steadily over the years, even going back to the financial crisis, and then how the recent stimulus packages up to $3 trillion are going to influence that. And you can see that it just shoots up right here. And the way that this works is the government essentially issues bonds, but then there's not enough buyers to take on that much government debt. So the Fed buys its own debt, and this is called monetizing the debt. And if they do this, they can essentially print unlimited amounts of dollars and put those into the financial system without needing to have actual buyers of those bonds. This was done during the financial crisis as well in 2008 and 2009, but I'd make the case that what's going on now is quite a bit different. So I remember back in 2008 and 2009 when the government was issuing billions and billions of stimulus to try to help the economy through the financial crisis. And I remember saying, like, holy cow, they're printing all this cash and they're just buying the debt themselves, and this is going to lead to long-term inflation. I just know it. And it never really did. We've seen very little inflation since the financial crisis, even though we've seen a lot of economic growth. And the reason why is because a lot of the stimulus that was done back then wasn't really a direct benefit to consumers or to businesses. It was to the financial institutions. So it was basically to bail out our banks and insurance companies that over-leveraged themselves. And when they got all that stimulus, it didn't go into the economy. They just kept it on their balance sheet to shore up those companies, and they sat on it as reserves. But what the government's doing now with its stimulus is a direct injection of cash to businesses and to consumers, and people are going to spend that money. So I think we're going to see quite a bit of inflation from this stimulus, unlike the past ones we've seen. And then the question is, how are we going to pay this debt back? What a lot of people are saying is that we're going to have to increase taxes, and that's going to lead to economic slowdown in the future, and it's going to be harder for stocks to make money. But I actually disagree. I think it would be impossible for any president to raise taxes enough to pay off $3 trillion of new debt in any significant amount of time. So what's the other option? Well, simply we don't pay it back. This is a permanent increase in the money supply, and if we let inflation go, it essentially can lower the government debt ratios for them. And I think that's a much more realistic strategy for how this is going to play out. So if we do have inflation in the future, who does that help? Well, if you're an investor in stocks or if you're a borrower, inflation is actually okay. If you are a saver, if you're retired, and if you're invested in cash or bonds, then inflation can actually be devastating because it erodes your purchasing power. So as soon as we start mentioning inflation is when everybody starts to think, I need to be invested in gold. Well, there's a whole nother video I can make on why I don't think gold is a good long-term inflation hedge, but I just have one really quick chart I'll show you to make that case. So this chart shows the returns on different asset classes over the last 200 and some years and on an inflation adjusted basis. So if you can look at the bottom here, you see the dollar is actually got a negative return when you look at it in terms of real returns or after inflation. Gold is just barely positive, 0.6% real return over all the years. And then if you look all the way at the top stocks, 6.8% real return. So I think this chart makes a pretty clear case that over long periods of time, there really is no better inflation hedge than stocks. So let me summarize by saying that I agree markets have bounced back very quickly and we still have some significant risk events on the horizon. But there's also a very strong case to make that even at these current levels, the upside potential for stocks is still there. And I want to emphasize two more points. First, stocks are for long-term investing. In the short term, nobody can predict market returns with accuracy, and there's always the possibility of a market sell-off next week or next month or this year. And this video is just to show you why I think it wouldn't be crazy to be putting money into stocks either. There's still some upside potential. Second is this video isn't meant to be directional investment advice, so I wouldn't take all your money and go put it into the stock market. But I also wouldn't encourage you to dump stocks either and try to time a downturn because that's a risky game to play in itself. The best thing you can do is keep a diversified financial portfolio that's appropriate amount of risk for your financial goals. Remember, financial goals don't change just because markets do. And that's all I have for today. But if you have questions or you'd like to discuss more, please don't hesitate to reach out to me. It's always a pleasure to hear from you. Have a good day.